The stock market is really easy money right now. After all, historically, recessions are when the most millionaires are made. But over the last few years, the whole entire landscape of the stock market has changed, with more new investors joining than ever before. And while that's a good thing, it's also made the market way more unpredictable. And we can see that in the volatility over the last few months. It's really important for every single person investing in the stock market or thinking about investing to understand why it's so unpredictable. And this video is going to do exactly that. And I'll also give you 7 tips on how to protect yourself in an unpredictable market and actually make money. Cheers! Hey everybody, my name is Hisham Khan and welcome to Income Over Outcome, where we talk all about investing and personal finance. Now honestly, investing isn't the same that it was 10 or even 5 years ago. See, the majority of the stock market is controlled by institutional investors, or what some people like to call smart money, like billion-dollar hedge funds and banks. These companies use complicated algorithms and pure logic when investing, which virtually removes any emotion from their trades. But over the last few months, we've seen a huge wave of retail investors like you and I join the stock market because of companies like Schwab, Robinhood, and TD Ameritrade making investing more accessible than ever before. And while that's a good thing, it's also completely changed the game of the stock market. Whether you'd like to believe it or not, the majority of retail investors trade on emotion and don't make as many smart decisions as hedge funds and banks, and that's why we're not called smart money. I mean, just look at this graph showing how the volume of Hertz trades went up after they filed for bankruptcy and their stock price was plunging. Any experienced investor knows that once a company files for bankruptcy, they have to pay off all of their debts, and they probably won't have any money to pay back shareholders. But I bet most people investing in Hertz didn't know that because they're inexperienced, they're trading on hype, and 99% of them probably lost money. Hell, penny stocks went up an average of 80% in the last week because of people following hype trains and basically gambling with the money they have. And I want to make that very clear. What most people are doing right now is not investing, it's gambling. Investing is based on reason and research. Gambling is based on feeling and the hope that you're going to make money. The surge of retail investors has made it really easy for the smart money to milk the market as much as possible. In past recessions, when stocks start going down, they're harder to liquidate, which drives down volume and sends the markets plunging. But now, institutional investors are able to sell trashy companies to people who don't know any better, and they're fully taking advantage of that. According to this CNBC article, the top stocks on Robinhood were actually the hardest hit during sell-offs. See, the average retail investor is just trying to get rich quick. Institutional investors can actually track what we are buying, and then they can buy up those stocks in huge amounts and send the prices surging. When the average person sees the stock going up after it's been going down for so long, they think it's a good buy, and they'll buy it without doing any research. And that's where institutional investors profit. They'll sell the stock knowing there's someone on the other end willing to buy a completely trash stock. It's basically free money for them. So here are 7 steps you can take to make sure you don't get burned. As we've all seen over the last few months, the stock market is extremely unpredictable. There's no way for anybody to guess if it's going to go up or down. And trying to time the market is why so many people buy high and sell low instead of buying low and selling high. Don't try and time the market. That's a wasted effort and it's probably only going to lose you money. You need to understand that it doesn't matter when you get into the market as much as it matters how long and how much you have invested. That's because the more you have invested, the more your investments are going to make for you. And to increase the amount you have invested, all you need is time. The longer you're invested, the more compound interest will be working for you. It's really a simple formula. To get around timing the market, the best strategy is to dollar cost average. Make it your goal to invest a certain amount into the stock market every single month. It doesn't matter if it's high or if it's low. If the market is going down, well then you get to buy in at a cheaper price. But if it's going up, then you're profiting and you get to add to your nest egg. Research shows that dollar cost averaging is proven to be successful over time. And if you do this consistently over multiple years, you can make millions of dollars, and that's not even an exaggeration. It's also really important to invest in broad index funds like these. No matter what people tell you, it's extremely hard to beat the market by buying individual stocks. Hell, even hedge funds have a hard time consistently beating the market, and a lot of the time they track indexes. The first step for any serious investor should be to invest in an index fund. It's the safest way to guarantee a positive return in the market over time. If you don't know, an index fund basically tracks all of the stocks on a specific index. For example, SPY is the S&P 500 index fund. So if you buy it, you're essentially buying a piece in every single stock on the S&P 500. This is great because it diversifies your investments and you don't have to worry about putting in work to research individual stocks and worrying about their prices every single day. If the S&P 500 does well, you'll do well. And as we all know, it tends to do well over time. Now, that's not to say that you shouldn't invest in individual stocks or stocks that have been hit super hard in the last few months. It can actually be a really good way to get high returns in the stock market, but you have to do it right. Once you have a decent foundation with index funds, you can move on to buying individual stocks, but make sure you're looking at fundamentals. If a company's down 40%, don't just invest because you think they're cheap and they're obviously going to bounce back because they're some billion-dollar corporation. Actually do your research to make sure they have the potential to bounce back. Don't be like the people who bought Hertz. Actually look at the company's balance sheet, PE ratio, earnings, future growth potential, industry trends, and everything else you can find on them. All it takes is Google and a few hours. I'm also a huge proponent of value investing. That's investing in companies that actually provide real value to society and are undervalued in the market. Companies like Amazon, Microsoft, AMD, and Disney are all great investments. You just need to make sure you're buying in at the right price, because a lot of the time, especially recently, these companies can be overvalued in the market. My last bit on individual stocks is to buy dividend stocks for passive income, but not stocks like Exxon that offer huge yields but perform terribly. If a company's value continues to go down, you're losing money even if they pay you a dividend. Plus, companies can take a dividend away anytime, so it's really important to look into what dividend stocks you're buying. Again, look at a company's fundamentals to see if they can actually support their dividend and if they're going to grow over time. My last and most important point is to not invest in penny stocks or other hype stocks as your main way of investing. I know how exciting it can be. Trust me, I've done it. But I hate to see people lose money that's important to them because they bought a stock just because someone else told them it's going to go up. If you really just want to give it a shot, then make sure you already have a strong foundation with the safer investments that I talked about before. Make sure you do extensive research on every single penny stock you buy and only invest with what we on Wall Street call FU money, or money that literally doesn't matter to you and you wouldn't mind losing at all. Like I said earlier, the stock market is easy money, but that's if you don't invest with greed, fear, or panic. Now that's easier said than done, but if you follow the tips in this video, I'm confident you're going to get there. Now that's all I have for you today. If you found something in this video helpful, be sure to hit that like button and subscribe for more. As always, leave any questions or comments you have down below and I'll be sure to answer them. I'll see you in my next video, but until then, cheers.